Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're about to embark on part 2 of our intermediate options trading course, where we're going to discuss some of the more practical part about options trading, which is selecting expiration dates and strike prices. Now, depending on the strategy that you're trading for your portfolio, there are different ways to select expiration dates and strike prices that are suitable and optimized for each individual strategy. However, today what we're going to talk about is more of an overarching theme in terms of how do you go about selecting the proper expiration dates and strike prices for any strategy. So we're going to talk about the theory of how do you go about selecting expiration dates and talk a little bit about why it's actually fairly counterintuitive when you're selecting expiration dates, and also same thing for strike prices, many times also counterintuitive as to why you should select certain strikes. So we want to talk about those, give you more of a visual approach as to how do you go about selecting expiration dates and strike prices. That's going to help you inform your decision so that regardless of what strategies you're trading, that you have a general idea as far as what are the optimal ways to select the best expiration date and strike price. So let's go ahead and get started here. Now, before I do, what we're going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So before I get started, for those of you that are brand new to OptionsPlay, welcome. What we're going to do today is we're going to show you a series of educational slides. We're going to talk about how to utilize the option chains to help you better understand what expiration date and strike price you should choose depending on the strategy you're trading. But more importantly, we're also going to show you a platform, OptionsPlay, that will allow you to leverage what you've learned and apply it to your own portfolios. And this is all free of charge, courtesy of the Montreal Exchange, that gives you access to OptionsPlay for free, pays for the education just like the one you are on here right now, the weekly options education, as well as a free video library and the weekly cover call and short put reports that we send out. Those are some of the strategies we're going to talk about here today. And you can sign up using this link here on your screen at optionsplay.com/TMX. So I'll post that link into the chat window for those of you that are brand new to OptionsPlay. And if you have not signed up for this service yet, it's free of charge. I highly recommend you to take a look at it. So like I said, today is part 2 of our intermediate options course. Part 3, we're going to revisit and go back to our market outlook session where we're going to talk about what symbols we currently look at and show you how we can apply the things we learned in part 1 and part 2 and answer all of your questions. So that's coming up in a couple of weeks. I'm excited for that. I'm really always excited about the market outlook sessions because we really get to talk about applying the things what we've learned to the real market, similar to the options education day many of you may have attended back in a couple of weeks ago at the end of April. Now, we do have all the recordings from that event. So for those of you that either attended or if you did not attend, we had a great 4.5-hour session where we had 4 speakers talk about how we all apply options in our portfolios. We gave examples. We showed you the trading simulator that you all have access to allow you to practice and paper trade options. So for those of you that miss it or want to watch the recording is available using that link on your screen, and I just posted that into the chat window. So today we're here to talk about expiration dates and strike prices, which for those of you that have used an options chain before, if you use the chain that looks like this, many times this type of page, it's sometimes very difficult to navigate because there are so many expirations, so many strike prices. If you feel that this is sometimes difficult for you to navigate, please type 1 into the chat window. Please bring up your chat window, which is at the bottom of your screen. If you find a page that looks like this, where you just have thousands of expiration dates and strike prices, sometimes difficult to navigate, please type 1. Can't see my screen. Let's see, 1 second. I apologize. There we go. Can you see my screen now? Still can't see my screen? Okay, great. All right, sorry about that. Sorry about the technical difficulties, but what I haven't shown much yet. But what I was showing was the option chain. the option chain where you have strike prices and expiration dates and strike prices. If you found that this type of page is difficult to navigate, please type 1 into the chat window, where you have hundreds of strike prices and expiration dates, and you're trying to figure out which expiration date should you choose, which strike price should you choose. This is many times for many people one of the most difficult things to do. And this is really part of why we started OptionsPlay, was because we realized that choosing strike prices like this off of a chain was difficult even for a professional trader, someone who has experience navigating these pages, who knows how to do quick back of the envelope estimations as far as where should you choose. It's still a manual process, even for the most experienced options trader. And that was really why we started OptionsPlay, because we were sick of actually continuing to make these types of manual choices every single time we traded. We wanted to automate it, and that's really how we started to build OptionsPlay. So today we're going to talk a little bit about how off of a chain that looks like that do you select optimal expiration dates, how do you select optimal strike prices, or what's the overarching theory as to selecting the optimal expiration dates. And then what we're going to do is we're going to go through some examples of different types of strategies and how they might differ slightly from what we're going to show you here today, so that you know how to apply them for specific strategies today. So let's go ahead and get started here. Now, first, we're going to talk about expiration dates. So what I have here on my chart is on my screen is a chart that many of you may have seen before. And this chart is a little exaggerated. It's not to scale, but it's meant to prove a point. What it's meant to show you is the value of an option price, that if everything else is held constant, meaning the stock price doesn't move higher or lower, how the value of an option price will decay as it gets closer and closer to expiration. This is what we call time decay. This is what we call theta, for those of you that like to use the Greek term. But as you can see, the value of an option will decay as you get closer and closer to expiration. And the x-axis here at the bottom is time as it gets closer and closer to expiration. And the reason that we draw the chart this way is to show you how much of time decay do you actually experience depending on how far out the option is trading. So if you trade, let's say this is a 12-month option here. Let's say you're trading a 12-month option here. From 12 months to 9 months, those first 3 months in a 12-month option, you're going to notice very little time decay. From 9 months to 6 months, you're going to notice a little bit more. From 6 months to 3 months, even further. And then as you get into the final few months, you really start to see this accelerate. We're going to show you some option chains to show you, why this or how much it is. Because again, this chart is not to scale, but it shows you that if you're choosing expiration dates, how much is the value of your option going to decay? Now, why does time decay matter? Because there are two things you can do. You can either buy an option or you can sell an option, right? If you buy an option, what do you want? You want to buy low, sell high. So you want to buy, and you think you want the value of that option to increase. If you're selling an option, what do you want to do? You want the value of the option to decrease. Does that make sense to everyone? Please type 2 into the chat window. If when you're buying, you want to buy low and sell high. If you're selling, you want to sell high and buy low. So if you're thinking about these two strategies, buying and selling options, let's talk about, if you're buying, first of all, where do you want to choose on the expiration date cycle? Do you want to choose something that is going to decay very fast, or do you want to buy something that decays very slowly? Please type the answer to the chat window, fast or slow. Right, exactly. David said slow. So when you're choosing options, when you're buying an option, you want to choose longer dated options, because longer dated options will decay at a slower rate. Meaning, let's say you want to buy an option and you think that the stock is going to move higher over the next month, right? You could certainly buy a 1-month option and hold on to it for that last month. Or you can buy a 3-month option and hold on to it for 1 month, because during that time, you're going to, let's say, have that much decay versus this much decay. So all of you are absolutely correct. When you're buying an option, you generally want to choose options that are longer dated, because longer dated options will experience less time decay. Now, you don't have to hold on to an option for 9 months if you buy a 9-month option. So you can hold on to an option for as long as you want. You can buy a 9-month option, hold on to it for, let's say, a month, and sell it. So that if the stock moves higher, you make money from the delta aspect of the option, but you lose very little to time decay. Now, vice versa, if let's say you're selling an option, where do you want to be on the time decay? Do you want time decay to be fast, or do you want to be slow? Type that into the chat window. As David said again, fast. So when you're selling an option, guess what? You want to sell shorter dated options because you're going to get that acceleration in time decay quicker, which means that you're going to collect your income faster. Okay, so right, a lot of you have the correct answer. Now, this is the part that when you're looking at a chart like this, makes perfect sense. But when you're looking at an option chain, many times that doesn't quite make a lot of sense because think about it. Let's go back to that same exercise, right? We said that when we're buying, we want to buy low, sell high. So here I have an example. This stock is BMO, okay? BMO today closed around $65. And this is the option chain for June, July, and September. June expiration is roughly 30 days away. July is roughly 60 days away. And September is roughly 120 days away, okay? Now, let's say you think BMO stock is going to go high. You want to buy low, sell high. So you're looking at the option chain. You say that I have the option to buy a June option. I have the option to buy a July option. I have the option to buy a September option. Let's say you have a short-term bullish view here on BMO, right? Maybe you think it's going to go up in the next 2 weeks, 3 weeks, a short period of time, not for 9 months or longer. So you say to yourself, okay, well, if I think it's going to go relatively quickly, right? And I know I want to buy low, sell high. Which option do you think you're going to choose if you're just looking at an option chain? So let's just use the same strike price here for argument's sake. We're going to choose the 66, 66, and 66, right? So the 66 Junes are trading at roughly about $2.55. The July's roughly $3.65. The September is roughly almost $5, right? So if you know that you want to buy low, sell high, which option do you choose, right? The Junes are obviously the cheapest. Julys are a little bit more expensive, and Septembers are really expensive. The Septembers cost double what the Junes cost. So when you want to buy low, sell high, naturally what you end up doing many times is you gravitate towards the shorter end of the spectrum. You actually end up trading shorter dated options, even though we just saw in the last example that if we look at it from a different perspective, which is the time decay perspective, it's very obvious that you want to buy the longer dated option. But here, when you're looking at an option chain, sometimes it reverses that, right? Because all you see is prices. You don't see time decay on a chain. So that's why whenever you're choosing an expiration date when you're buying, it's very counterintuitive many times to trade a longer dated option. Now, just because we learned that longer dated options have lower theta does not necessarily mean that we should go out there and just buy a 3-year option, right? There are some options that have very long dated options, and those certainly have the smallest amount of time decay. But there are other factors that you need to consider as well in terms of liquidity, in terms of how much extrinsic value are you paying or how much intrinsic value is there in an option, because the extrinsic value is what's at risk when you buy an option. So keep that in mind. This is not necessarily to tell you that whenever you have the option, you buy the longest dated option possible. It just means that if you're choosing between 2 expiration dates, maybe you're looking at the Junes or maybe you're looking at the Julys, best case to do is to choose the longer dated option. In this particular case, maybe July. You might say to yourself, September is too long because I'm only bullish on this for the next few weeks. I shouldn't go out there and buy an option that expires in 120 days. That's just simply too long. But when you're trying to choose between 2 expirations, maybe you're trying to choose between 2 weekly expirations. Maybe you're looking at the June 19th, the June 26th weekly expirations. Which one do you want to choose? You may want to choose that longer dated option because during your holding period, you're going to experience smaller time decay, which is going to evaporate less of your profits when you're buying an option. Now, if we flip this on a dime and say that we want to sell an option, right? So let's say we want to sell a BMO cover call, right? Maybe we want to sell here in this particular case, maybe the 68s. Because you think that BMO in the short run is near a top and we want to sell a cover call. So you look at selling a short dated call, you would get about $1.50, $1.60 or so A 60-day option, about $2.60. A 120-day option, roughly almost $4. So when you're selling options, what do? You want to sell high, right? You want to collect as much income as possible. So many times when users are looking at an option chain and they're trying to decide which expiration should I sell on a cover call, we tend to find that a lot of investors gravitate towards the longer dated options, because guess what? The longer dated options have more income. Who wouldn't want $2.50 in income versus $1.50 in income? I certainly would rather have $2.50. But what you learn very quickly is that here's a 30-day option. If I can collect here in this particular case about $1.50, let's just call it $1.55 in 30 days. Here in 60 days, I'm collecting what? $2.50, let's just call it $2.60. Now, tell me, is 155 multiplied by 2 greater than or less than $2.60? Type in yes or no. Is 2 times $1.55 greater or less than $2.60? Exactly. It is greater than, which means that you can sell a 30-day option twice, right? In this particular case, twice, and collect this particular case twice, which would be $3.10. You could collect $3.10 versus only $2.60. Which one would you rather have? I'd much rather have $3.10 than $2.60. So that's why when you're looking at an option chain, especially if you're looking at stuff that's closer, right? Sometimes you're looking at the June 19th versus the June 26th, and it doesn't really make a lot of sense here that when you're selling these longer dated options that you're trying to choose the one with the most income, but it's actually very counterintuitive that if you choose the expiration date with the least amount of income, what that means is that you can sell it more often and it's going to add up to more income for you in the long run, even though on the surface it looks like it has less income, okay? So that's why when you're choosing options expiration dates, many times when you're buying options, longer dated options, counterintuitively doesn't make sense because you're paying more for it. Vice versa, if you're selling an option, it's counterintuitive to sell the option that has the least amount of premium, but again, it makes up for itself because you're able to do it more often. I see a question from Anna asking, why multiply by 2? Because in the same time between now and July, which is 60 days away, I can sell 2 monthly options, which will, at this point, collects me about $1.55. $1.55 multiplied by 2 gives me $3.10. That adds up to more income for me than someone who sold a single July option and held it all the way for 60 days, okay? So I hope that makes sense to everyone. Does that make sense? Please type 3 into the chat window if that makes sense to you. Okay, great. I see a lot of 3s. Now, if this is your first time trading options, this might be a little, number one, a little counterintuitive for you. Number two, you still might be learning some of the terminology and you're still trying to figure this out. That's okay. That's part of why we record these. That's part of why we make these slides available to you afterwards so that you can really do this, you can learn at your own pace. We don't expect you to necessarily learn everything live as we're going along, but we also allow you to ask questions. So Anna, great that you're able to ask a question. We'll get to more questions here at the end. So now that we talked a little bit about expiration dates as far as how do you select the optimal expiration date, buying longer dated options, selling shorter dated options. Now let's talk a little bit about strike prices. Now, just like expiration dates, many times on most options chains, you have tons of strike prices. So when it comes to strike prices, it really, I mean, there's a few different factors that you have to consider when you're selling, when you're thinking about strike prices, but the general rule of thumb actually still is the same. So before I showed you the time decay of an option it's just more of a representation of time decay as it accelerates towards expiration. Now what I have here is a chart of what the different time decay looks like depending on which strike price that you actually choose. So in the money options, or options that are in the money, they have relatively low time decay because in the money options actually have a very small amount of extrinsic value. There's very little that can even evaporate to begin with. So when you're buying an in-the-money option, it has very little time decay. If there's any, it usually accelerates only at the very, very end. When you buy an out-of-the-money option, it is all extrinsic value. And the thing about it, the at-the-money, out-of-the-money options is that it will always decay relatively quickly, because even if the trade goes in your favor, it's still out of the money. It's still all extrinsic value, unlike an at-the-money option, which as long as the stock starts to go in your favor, the trade starts to go in your favor, the at-the-money option will actually become an in-the-money option, which will mean that the time decay factor will decrease, so that at-the-money options are somewhere in between here. So when you're thinking about this also factors into, depending on whether you're buying or if you're selling, which one where do you want to be on the curve? So think about it. If you're buying in the money, if you're buying an option, right, and you want the value of that option to go higher, where do you think you want to choose your strike prices? Do you want a strike price that has low time decay, or do you want a strike price with high time decay? So please type in your answer. If you're buying an option, do you want to choose in the money, at the money, or out of the money option? So low, the people who answered low, that is correct. In the money is correct, because whenever you're buying an option, you want that time decay to lessen. You want the smallest amount of time decay possible, so that when the trade goes in your favor, you have delta that works in your favor. You have other potential, maybe gamma, working in your favor, but time decay is the factor that's really working against you when you're buying an option. So the way to offset that is by buying an option that's in the money. Now, there's different degrees of in the money, and we'll talk a little bit about that in the specific strategies. But generally speaking, when we're buying an option, we want to buy something that's slightly in the money. We don't want to buy something that's really far in the money. I'll talk a little bit about that next. So now that we said buying an option, you want to use a at the money option. What if we're selling in the money option? What if we're selling an option? Where do we want to be when we're selling an option? Michael's the first one to say out of the money. Exactly. When we're selling an option, we want to be out of the money because, we're selling an option, we want to be out of the money because out of the money options will decay faster, right? Because when we're selling an option, we want the value of that option to decay to zero. And out of the money options will decay at the fastest rate. And even if a trade goes against you, those out of the money options, generally speaking, will stay out of the money, which means that time decay still continues to accelerate. Versus if you sell an at the money or in the money, as a trade goes against you, you have almost no time decay left. So you have nothing working in your favor, and you can only hope that the trade reverses trend and comes back in your favor. So you're just making a directional bet. You're not really betting on the fact that time decay is going to work in your favor. So that's why whenever you're selling an option, you always want to start out of the money, okay? So when we look at strike prices here, this also is the part that sometimes is a bit counterintuitive, because when we're buying an option, you want to buy low, sell high, right? So if we're looking at this, this is the same example here. I have BMO, which closed today around 65. Sorry about the poor handwriting here. BMO closed somewhere around 65, so somewhere in between here, between 64 and 66. So let's say we want to bet that BMO is going to move higher, right? So we want to buy a call option. So we have a few choices. We can buy a $64 call option. We can buy maybe a $58 call option, or we can maybe buy, let's say, a $72 call option. So whenever we're buying, what do we want to do? Buy low, sell high, right? So when you're choosing a strike price, buy low, sell high. When you're looking at an option chain, guess what? Where do you naturally gravitate towards? Especially investors who are not familiar with options, who don't really understand the difference between at the money, out of the money, and in the money in terms of time decay, in terms of how extrinsic value works and how delta works. Naturally, you will gravitate towards a strike price that has lower cost, because whenever you're buying an option, you want to buy low, sell high, right? So guess what? 72 options are the lowest priced options. These are only about $1.20. So why would I want to buy something for $5 when I can buy something for $1, right? I can buy 5 times as many of these $72 call options as I could of these $64 call options. But this is the counterintuitive part about options trading, is that it's actually better for you to buy that more expensive option, because this is going to all decay, even if the trade goes in your favor, even if the stock goes up. Let's say it goes from 65 to 70, right? You're still out of the money, and all of that value is still going to evaporate unless the stock goes significantly higher above 72, which obviously has a low probability of happening. And this is really why whenever you're buying an option, you generally want to gravitate towards strike prices like this. Yes, this option will have the least amount of time decay, but many times that the difference in terms of time decay between these two are not significant enough for it to be worth paying double the price. And that's why whenever we're buying an option, generally speaking, we always start with a strike price that's near the current price. So $64 is usually the starting point that we would use on buying an option. Conversely, if we're selling an option, you can certainly sell, let's say we're selling a cover call on BMO. So let's say we own BMO stock. We think the stock is going to go higher, but we want to generate some income. So what we want to do is we want to choose strike prices. You can choose maybe the 68, the 70, and maybe the 72. Now, whenever you're selling an option, we always want to sell high, buy low, right? Sell high, buy low. But the problem here with sell high, buy low, if you sell a $64 option, you can get $5 in income. That certainly sounds much better than getting, let's say, $1 in income. But the one thing that you want to make sure that you understand is that when you sell a far out of the money option, it's going to be all time decay. Even if BMO stock rallies, it's still all time decay that is likely going to evaporate all to zero. When you sell a $64 call option, there's some of it that's intrinsic value that will never evaporate. And that's not something you want whenever you're selling an option. So whenever you're selling an option, you actually want to sell the options that have relatively low premium, even though you know that you want to sell high, buy low, because the higher strike prices, or the strike prices that are further away from the current price, number one, have a low probability of ever being in the money. And what that means is that you have a higher probability that all of that value is going to evaporate, and that's income for your portfolio. So whenever you're selling an option for income, you generally want to gravitate towards strike prices that are out of the money, okay? Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Okay, perfect. I see a lot of 5s. Great. So now let's talk a little bit about some of the strategies, because everything that I've taught you is an overarching theme that you can use for any strategy. So regardless of whether you're a beginner and you're just starting to sell your cover call, you can use this for that. Or you're a very advanced trader and you're trading iron condors and butterflies, you can use the same concept for choosing your expiration dates and strike prices for any strategy. That's the beauty of what we're teaching you here today. But we're going to explore some of the more common strategies and how you can apply what we've learned here to those common strategies. So we're going to start off with cover call. The simplest of option strategies, the first strategy that you're likely going to be able to execute in your trading account when you first apply for an options account. So a cover call is when you're selling a call option against stocks that you own to generate income. And a cover call obligates you to sell your stock at a future time at a specific price, just like placing a limit order to sell your stock at a higher price. That's exactly what a cover call obligates you. But the difference between a cover call and limit order is that a cover call pays you income, which is something that you can use to buy protection, meaning buy puts, or you can simply use that income the same way that you might use the income on a dividend on a stock for funding your secondary or an income stream for yourself. So cover calls are an extremely popular way for equity investors to generate more yield from your equity investments beyond just what you currently receive from the dividend. So whenever you're selling cover calls, you generally want to skew more towards the shorter end of the spectrum. Usually a good starting point is somewhere between 30 to 45 days out. So 1 month, 1.5 months out, you usually don't want to go further out than that, because anything further, you can sell shorter dated options and do it more frequently. You know, at 60 days, if you sell a 60-day cover call, that is the same thing as selling a 30-day option twice, right? And we know that if we sell a 30-day option twice, guess what? that adds up to be more income than what you can receive from selling a 60-day option. So whenever you're going beyond 45 days, what you're really giving up is quite a bit of income. So anything greater than 45 days, you should be selling shorter dated options. As far as cover call strike prices go, this is really where this is one of the strategies that differs quite a bit from the other ones. But when you're selling cover calls, you really want to choose strike prices that are really far out of the money. Usually about a 15 to 20 delta is a good starting point. Now, for those of you that are saying, what's delta? Delta is an approximation of what is the probability of that strike price being in the money at expiration. And just to give you a quick example here, something at a 50 delta, something at the money here, so something at here would be roughly 50 delta, because there's about a 50% probability that the stock will be above that price at expiration. And the further you go up, the lower the deltas. So if you look at an option chain, this might be 40, this might be 30. Now this is not to scale again at all, but again, you might see something like this. And this is just telling you that there's a 40% chance that this stock will be above 66, a 30% chance it'll be above 68, a 20% chance that stocks will be above 70, and a 10% chance that the stock will be above 72. Okay, so delta tells you the probability of the stock being above that specific price, and the further away, the smaller the probability. So the probability-based approach to selecting strike prices is one that we use here at OptionsPlay. That's how we select all of the strike prices that we show you on our platform, because a probability-based approach is the only approach that naturally accounts for changes in volatility, because you don't always want to just choose something that's 5% in the money or 5% out of the money, because some stocks are more volatile than others, and you want to adjust for the fact that some stocks are double or twice as volatile as others. And then you also have periods of more volatility like we've experienced over the last few months versus the 2 months prior to that, which was very quiet from a volatility perspective. So delta will always naturally account for that in the markets. So when the markets are more volatile, it will naturally select a strike price that's further away. When things are quiet and the stock is relatively quiet, it will naturally select a strike price closer, and will always adjust your strike prices based on probability. And when you adjust your strike prices based on probability, what you get is a very consistent trading experience. So whenever you're selling a cover call, if you always choose a 15 to 20 delta strike price to sell, you'll always experience that only about 15 to 20% of the time will your stock get called away. Now, if you use, let's say, another example, and I know many cover call traders will use something like, they'll always sell a cover call that's let's say 10% out of the money. What happens is that when things are really volatile, things will get called away a little bit more frequently. And when things are not as volatile, things will get called away less frequently. You get a somewhat inconsistent trading, I would say, strategy from month to month. But if you choose delta every single month, you should expect about 15 to 20% of the cover calls that you sell will have your stock called away, or roughly 80 to 85% of the calls you sell will expire worthless. So that's why it's so important to use delta to calculate your strike prices, because it naturally accounts for volatility. I want to make sure everyone understands that. So if that makes sense to you, please type 6 into your chat window. For those of you asking, what is delta? How do you calculate delta? Your platform will provide you with delta, and I will show you how to access it using OptionsPlay here in 1 second as well. So when you're selling puts, now this is a strategy for acquiring the stocks that you own. So let's say you want to buy a BMO stock. It's trading at $65. Normally, as a stock investor, you'd place a limit order. Maybe sell a limit order at $64, hope that the stock reaches $64, and then you own the stock. You can also sell a put option at $64, which obligates you to buy the stock just like a limit order, but just like a cover call, compared to the limit order, when you sell a put, you actually get paid some income, and that income will provide a discount to your stock purchase. So that's why, for those of you that are beginners, if you're thinking about selling a cover call, I absolutely encourage you to take a look at selling puts as well, as the way to help you get into that stock, because it helps you purchase your stocks at a discount. Sometimes it's not much of a discount, maybe 0.5% or 1%, but that's still a 0.5% or 1% that you didn't have otherwise by placing a limit order. So you might as well take that type of income on your stock purchase, because if you could purchase every single stock for 0.5% or 1% discount, it does make a difference at the end of the day for your entire portfolio. So when you're selling a put option, same thing, 30 to 45 days. You don't want to go out further than 45 days, because if you go out further than 45 days, you can sell shorter dated options more frequently. Now, the difference here with short puts is that you actually want to sell something that's really close to the current price. So about a 40 delta, something has a much higher probability of this put being in the money, because when you're selling a put option, you want to own the stock. So you want to increase the probability of owning the stock. So that's why we use a 40 delta. So a 40% chance of owning that stock. Usually this will generate, like I said, roughly about 1% discount on your stock purchases for each month you sell. So for a 30-day put, you should roughly collect roughly about 1% of the underlying stock price as a general rule of thumb for this type of strategy. On some more volatile stocks, like some of the marijuana stocks, you'll generally find that you could collect 3, 4, 5% of the underlying stock price. And when you get a 3 to 5% discount on a marijuana stock, even though they're very volatile, that can be a significant savings on that stock purchase. So highly recommend you to take a look at that type of strategy for those of you that are interested in buying some stocks. Lastly, we'll talk a little bit about credit spreads. This is a much more advanced strategy. This is something we're going to cover in our intermediate options course. Selling a credit spread is really similar to selling a short put or a cover call, but you're doing it naked. You're doing it basically without the intention of owning the stock or ever having the stock that you're going to deliver. So selling a credit spread involves selling, again, a 30 to 45 day option, not longer than that, and then selling an at-the-money call or put. Now, when you sell an at-the-money call or put, this is really an option that has the highest amount of premium for you to collect. But when you sell a naked call or put, you have unlimited risk. Both of these strategies have truly unlimited risk. Now, technically, short put doesn't have an unlimited risk because the stock can't go below zero, but I usually consider that as unlimited risk. So one of the ways that you offset that unlimited risk is by buying an out-of-the-money option. So whenever we're selling a credit spread, we always want to sell an at-the-money call or put and then buy back a call or put that's roughly a 25 delta, or about a 25% chance that the stock will exceed those strike prices. Now, again, that's a more advanced strategy. That's not a strategy that everyone here on this particular call is going to be trading in their accounts. But for those of you that do, or those of you that are interested in learning about credit spreads, we will teach about that here in the intermediate course. But this gives you a quick primer as to how to select those strike prices. I definitely recommend you to learn more about this strategy before you deploy this if this is your first time learning about credit spreads. So those are the income selling strategies. This is when we're selling an option for income. Now, the thing about income strategies is that they all have what's called a fixed reward, meaning whenever you're selling something for income, no matter what happens, the most you can make is the premium that you collect on that strategy. Your risk is many times that. So when you sell a cash secured put, the premium or the risk that you have is substantially larger than the income that you receive. When you sell a credit spread, your risk is many times double the reward that you could potentially receive. So the risk to reward on income strategies is really skewed against you. And that's why the probability of success on many income strategies are relatively high. So on the flip side, whenever you're buying an option, this is really where, when you're buying an option, the probability or risk to reward is really skewed in your favor. I'm sorry, risk to reward is skewed in your favor, probability is skewed against you. So it's important that we all look at this from that perspective. Sorry about that. It's important that we look at this from that perspective, because whenever we're looking at buying an option, you want to buy something that's as cheap as possible. So whenever we're looking at directional strategies, now we always want to choose expiration dates that are longer, as we just showed you here before. So whenever you're buying an option, you want to choose something that's about 45 to 60 days away or greater. So it really depends on how far your outlook is. many times I tend to find that many options traders, your outlook may only be a few days to a few weeks. That's why we always start off 45 to 60 days out as your starting point using OptionsPlay. But if you have an outlook that's maybe 3-4 months long, just make sure that you choose an expiration date that's longer than that time frame by at least 2 to 3 months. So if you expect that your outlook is, you expect a 3-month bullish outlook, you might want to choose maybe a 6-month option, giving yourself that 3-month buffer so that you're not holding that trade within the last month of expiration. Because that if you buy a 3-month option and you hold it for 3 months, you're holding it through the time period where it accelerates on that time decay. So whenever you're buying an option, you want to buy at least 45 to 60 days out. 50 to 60 delta, slightly in the money options are suitable here for whenever you're buying a call or a put. Now, when we're trading debit vertical spreads, this is a strategy that we've already covered in our Beginners Options Master Course. I hope that many of you were able to catch that session where we talked about how to apply leverage to your portfolio. That's the one where we talked heavily about using debit vertical spreads, because debit vertical spreads are really just an improvement to buying calls and puts. It's not substantially different from buying a call or a put, but what it does is it reduces your risk, it increases your probability of profit, and it reduces the time decay factor of a long call or put, because not only are you long an option, you're also short an option. So you really get the benefit of both worlds here when you're trading a vertical debit spread. But when you're trading a vertical debit spread, you're also choosing 45 to 60 days. You're also buying the 50 to 60 delta call option. You're actually buying the same one as you're doing up here. But what you're doing is you're selling a far out of the money option against this. So this is really where you're really optimizing both sides that we're talking about. We talk about buying an options that's in the money, that has low time decay. And then what you're doing is you're selling an out of the money that has high time decay. And the two offset that time decay a little bit, meaning the short leg's time decay offsets the time decay of the long leg. And this allows you to stay in a trade a little longer. It also reduces your risk and it increases your probability of profit on the trade. So this is a strategy that we are that we use very heavily in our trading, which is using debit vertical spreads, because it's one of the most efficient ways to apply leverage using options that you can't do by any other strategy. So using spreads is one of the best ways to really utilize everything that I taught you here today, a combination of buying and selling options that give you the best outcomes for your strategies from a probability and a risk reward perspective. So with that, what I want to do is I just want to quickly summarize what we learned here today and then open this up for Q&A, because I did cover a lot of things here with you. I want to make sure that I give you the opportunity to ask some questions. So even though we covered a lot of things here today and I showed you a lot of different examples, the summary is actually quite short and quite simple, because everything that I've taught you here today is actually really simple. It's just sometimes a little counterintuitive, especially if you're a first-time options trader and you're staring at that options chain and you're seeing all of these numbers and you're not sure where to start. So the overarching rule of thumb that you want to keep in mind, that when you're selecting an expiration date, whenever you're buying, you want to gravitate towards the longer dated options. It doesn't mean that you have to trade a 12-month option. It just means that if you're choosing between the Junes and the Julys, you may want to choose that longer dated July option, because during the holding period of that July option, it's going to evaporate, or time decay is going to be less of an effect on a July option than it is going to be on a June option. Vice versa, if you're selling an option, you want to do the exact opposite. If you're choosing between June and July, choose the June option, because the shorter dated options will have faster time decay, which means that you're going to collect your income a little bit faster. So if that makes sense to everyone, please type 7 into the chat window for expiration dates. And then lastly, strike prices. Whenever you're buying an option, as we know, we want to buy low, sell high. So to do that, a little counterintuitive as well, you want to buy an at the money or slightly in the money option that's going to, on paper, look more expensive, but it's actually going to give you substantially better returns if the trade goes in your favor than buying an out of the money option. So whenever you're buying an option, you want to buy at the money or slightly in the money. And then when you're selling an option, you want to sell out of the money because those are going to evaporate. Even if the trade goes against you from a directional perspective, those out of the money options will likely stay out of the money and will still evaporate to zero, or have a much higher probability of evaporating to zero, which is what you want whenever you're selling an option. So that is, in conclusion, what I wanted to show you guys here today. Like I said, a lot of examples, but not difficult. Just fairly simple rules to keep in mind. And I hope that these examples that I showed you illustrated to you why sometimes when you're looking at the option chain, these rules sound counterintuitive and sound like they don't line up with what you've been taught. But I hopefully, with the different graphs that we showed you, we were able to show you why it's important to select these types of expiration dates and strike prices for your trading. So with that, I want to thank everyone for taking the time out here this afternoon. At this point, what I'll do is I'll open this up for Q&A. So if you have any questions, please type them into the Q&A window. There's both a chat window and a Q&A window. Please type them into the Q&A window, and I will answer your questions there in the Q&A window. And while we wait for you to type in your questions, I just want to remind everyone to register for this free tool that's available to you. You can register at optionsplay.com/TMX, and then you can log into your platform at tmx.optionsplay.com, which I will post the link to everyone here in the chat window. And I see a question here, where is Delta in OptionsPlay? Great question. So you can choose Delta here in OptionsPlay by clicking on the blue share button here on your P&L chart for any strategy. And at the very bottom, there is a link that says Explain Strategy and Greeks. If you do that, you'll see Delta, Theta, Gamma, and Vega. And we actually express Delta, Vega, and Theta, and Gamma in a slightly different term because when you're looking at Greeks, you generally want to know what is the impact it has on your on the option that you've bought or sold. And that's why we express Delta, Theta, Vega, and Gamma in dollar terms, which is predominantly what you're really looking for when you're looking at Greeks, is you want to know what dollar amount does it affect my option. And you can see by far, Delta is many times the biggest factor, which is why direction is first and foremost the most important one for you to keep an eye out on for your trading. So keep that in mind. Directional view in your options account is the most important one because Delta has the biggest factor in the value of your option. All the other ones are significantly smaller impact on the changes in the value of your option. John is asking, wouldn't you want to buy in the money calls so you have no time decay? So John, absolutely. But like I said, there is diminishing returns. So you can certainly buy something that's really far in the money, but what you're really losing at that point is the convexity or the leverage ratio that you're really shooting for when you're buying an option, right? So let's look at BMO, which closed at 65. Let's look at maybe the June options. So as you can see in the June options, I can buy a $50 option, which is significantly in the money for 15 bucks or 15.90, right? In this particular case, I'm really not getting a lot of leverage here, and I'm trading something that trades very closely to the stock. That's generally not why we trade options. When we trade options, we want something that has leverage. We want to trade something that has convexity so that as we get correct, it gets more and more correct. And if it goes against us, it'll actually decrease that leverage ratio. That's why we always want to start with something that's closer to at the money option than something that's further in the money. Because again, theta is one component of your strategy, but it's not the end all be all. Delta is still by far the biggest factor of your option, which is why whenever we're buying an option, we usually use Delta as our primary decision maker as to where we want to buy or sell, and theta is more of a secondary indicator here. So that's why whenever we're buying an option, we don't buy far in the money options. When's the most optimal expiry dates to sell? So usually about 30 days is a very good starting point for selling options. Previously, I saw 9, 6, and 3, assuming months. Yes. Well, actually, I'm not sure that those two questions are related, Brian. You generally want to sell roughly a 30-day option because that's really where time decay accelerates in that last month As you can see, it's almost a straight line down in that last month. Again, this is not to scale, but it just shows you that in the final weeks, in the final months, and the final month, that's really where you're going to see the fastest time decay. So whenever you're selling options, you want to gravitate towards shorter dated options here in that last month or few weeks. I don't understand selling options before they expire. How much is this going to cost me? How do I decide when to sell early? I think that perhaps there's a bit of a disconnect here in terms of when we say selling options, we're not talking about selling an option that you own. We're talking about selling an option that you don't own, such as like shorting a stock that you don't own. So selling an option is just like shorting a stock. You basically sell something at a price that you think is going to go to zero. And if you sell an out-of-the-money option, you have a relatively high probability that that option is going to zero. And that's why we sell out-of-the-money options. Also, when you talk about straddles, so we will not talk about straddles here, but straddles are really just buying a call and a put together. That's it. You know, I'll be honest, when do you ever want to take a bullish and bearish bet at the exact same time? The answer is probably not very likely. You'll likely always either lean a slightly bullish or slightly bearish. So that's why I have never heard of a long straddle strategy that has made money in the long run, because you're basically betting that the stock will go both up and down at the same time, and it just simply doesn't happen. It means NTM is the best generally buy position. It means in the money is the best generally buy position. If that's your question, that's correct. Again, if you've submitted a question into the chat window, if you don't mind, please post it into the Q&A window. That would be really helpful for me to organize this. Maurice is saying, I understand the theory regarding expiration dates and strike prices and time decay. However, isn't a lot of this already factored into the prevailing option premium? I don't know what you mean by that. The only thing that's factored into the option premium is volatility. It is not factored into, I'm not really sure I understand your question, Maurice. The option premium is really a factor of volatility. Everything else is something that you can calculate, which is why we want to follow these formulas. So if everything else held constant, you always want to sell short dated options and you always want to buy longer dated options. So that stuff is held constant, and that's why that's why these rules are there. Is there much chance the delta is calculated incorrectly? Well, John, it depends on your brokerage firm. There obviously are some intricacies to calculating delta, such as interest rate. Chances are you wouldn't be off by much. You can be off by a little bit, but usually that little bit is not quite enough to completely wreck or make a strategy. So yes, it's possible, but I don't really see that as being a big factor. Wallace is asking, for credit and debit spreads, what would be the optimal width of strike prices between long and short legs? So Wallace, we always use delta. We always use delta. There is no optimal width in terms of dollar amounts or even percentage amounts. We always use delta. When buying an option, are you better off buying one that is far in the money? So not too far in the money, because again, if you buy something that's too far in the money, it's going to cost you a lot. You're gonna reduce. You're not going to get the leverage ratio that you're really looking for when you're buying an option, and the delta at that point, or the gamma of an in the money option, is relatively low. So if the trade goes in your favor, you're not making you're not getting any increase in leverage. If a trade goes against you, you're not really getting any decrease in leverage. And that's really why being at the money or slightly in the money gives you that added benefit, so that if the trade goes in your favor, you get increased leverage. It costs you less to begin with, and you get increased leverage if the trade goes in your favor. And if the trade goes against you, it reduces your leverage, because gamma is highest with at the money options. So that is why whenever you're buying an option, you generally want to buy something that's at the money or slightly in the money. What are the names for debit vertical spread? That's a bull call spread, or a bear put spread are the debit vertical spreads. Yeah, I think that answers your question, Boris. Vertical debit spreads has a profit cap. Why would you still do that? Great question. Because whenever we're trading an option, options have expiration dates. Do you really think that the stock is going to infinity between now and June or now to July? Obviously not. So you want to optimize that by selling some premium, collecting some premium, and that help offsets the cost of that trade. So for example, let's say I'm looking at, let's go to BMO. Let's say I think BMO is going to continue moving lower between now and July. But guess what? I don't think the stock's going to zero by July. So let's say I think that, and we automatically choose a strike price that only has a 15% chance of moving, right? So if it gets the 50, we're buying the $66 put, the slightly in the money put, but we're also buying the 66 put and selling a 56 put against it. So guess what? By selling that 56 put against it, I can certainly pay $410 for the $66 put, but I can pay only $290 if I sell the 56 put. Because again, between now and July, how much lower can BMO possibly go? Even if it exceeds 56 by a little bit, what you're going to see here is that even, let's say the stock does go to 56. Here, I'm paying $410 to make $590, which is not a bad return, right? 143% return. But if I use the vertical, I'm only risking $290 to make $710, which is a 244% return. That is why you want to cap your profits. And even if you're wrong on this and the stock goes a little bit further, right? Notice how much further the stock needs to go before this starts to outperform this. It has to reach $51.85 before this strategy beats this strategy. Now, the stock's at 65. Notice how far it has to exceed that lower strike in order for that debit spread to start underperforming. And I would say that, yes, that can possibly happen, but the chances of that happening are so low that I would much rather that 9 out of the 10 times that when it doesn't happen, I get substantially higher returns. And that 1 out of 10 times when it really just makes that big move, I give up a little bit on gains, but guess what? Is getting a 244% return on this particular trade a bad result? I would hardly call that a bad result. So in the long run, we clearly see this type of strategy will outperform this strategy all the time. That's why it has an options play score of 151. Is it possible that it will underperform? Absolutely. But the chance of that happening, very slim. And even if it does, it's still not a bad result to have a strategy that is capped. And if you reach that cap reward, again, not a bad result. Wallace, are you planning to introduce Canadian edition of the daily play? So, unfortunately, the TMX is our customer here in this particular case. They are the ones providing you this tool completely free of charge for Canadian options. As part of the restrictions that we have with them, we are not allowed to provide any type of recommendation or advice or even anything that looks like it, which is why we can't provide a daily play here for the Canadian markets as much as I would love to. This is something that we've spoken to them many times about. But unfortunately, at this point, we are not able to do that. Can you go over in the money and out of the money again, why it's significant when buying versus selling? Okay, I'll do that really quickly. So in the money options will decay at a much lower rate. So whenever you're buying an option, you obviously want to buy something that's going to decay smaller, because if let's say you buy an option that's $10 and at most it's only going to decay, let's say down to $9, then you only have $1 of time decay. But if you buy an option that's, let's say, $3, but you know it's going to decay to 0, then you have $3 of time decay. So you basically are knocking off $3 versus the value of the option, versus here you're only knocking off $1. Which one do you want to lose, $3 or $1? I will always want to lose $1 instead of $3. That's why whenever you're buying an option, you want to buy something that's in the money, because it has less time decay to bleed off. So I hope that answered your question, Kenneth. Agnes, what delta do you pick when you sell naked puts you don't want to be assigned? So Agnes, I will tell you, I'm not an advocate of selling naked puts. Why sell a put if you never intend on buying the stock? Because guess what? When you sell a put, you will be assigned at some point. But to answer your question, if I was to sell naked puts and I didn't want to get assigned, I'd probably sell something maybe about a 25 or 30 delta. That's what I would do. But again, I wouldn't do that. I think that if you're going to sell a naked put, you might as well sell a put spread. You're going to collect probably a better premium on selling a credit spread than you would on a naked put, and you don't have the risk of taking unlimited risks of the downside. Renee sold cover calls on GDXJ 1 week ago using your approach, and 2 days later cover calls that brought $1.11 were worth $1.50, which means I have to buy back the calls. What have I done wrong? Renee, you haven't done anything wrong. You also don't have to buy back those calls. You can let that $1.11 evaporate. It will evaporate at some point. Now, it really depends on whether or not you want to lose that stock, right? So selling a cover call is completely different from some of the other strategies, because once you sell that $1.11, that's your profits, that's your income to receive, because whatever 40 cents that you've lost on the call option, you've gained that on the underlying stock. So you didn't actually lose that money, you gained it on the stock position. So keep that in mind. At the net end result of all of this, you will be $1.11. You will have $1.11 more in income at expiration. You just have to wait till expiration for that to happen. So be patient. You've done nothing wrong. I wish CRA would allow debit vertical spreads within non-taxable accounts. Unfortunately, as much as I would like that as well, I cannot influence that. What if you don't want to own a put? Just create an income stream selling them. What delta do you use? I don't know what you mean by if you don't want to own a put and just create an income stream selling them. You can sell puts, you can sell put spreads, you can do all of those things. Selling puts, I would sell maybe a 25 delta. Selling credit spreads, which is be my preference, you would sell the 50 and buy back the 25. What level of options authorization is required for vertical spread strategies discussed today? Usually it's a level 3. It depends on your broker, but generally speaking, it's 1 level above buying calls and puts. For vertical spreads, if you sell at the money, aren't you at risk of being assigned? So you're not really risky at being assigned until expiration. So whenever you're selling a credit spread, and this is something that we do discuss during that course, is that selling a credit spread, generally speaking, your goal is not to hold it all the way through expiration. You usually want to buy back that credit spread, usually about a week before expiration. So your risk of assignment is certainly there, but it's usually pretty low. And keep in mind that just because you get assigned on a credit spread doesn't change the risk at all. I mean, a lot of people talk about assignment as if it's this really bad thing. It doesn't change the risk of your strategy at all. You're just swapping in a short leg for either a long or short stock leg. But the risk of the strategy still remains the same. And in reality, when you get assigned early on a credit spread, you've actually made money quicker than if you held it through expiration, because the person who exercised that put or call gave up that intrinsic value, and you gave up the extrinsic value, and you actually gained it. So you can close out a credit spread as soon as you get assigned, and you're actually gaining in value quicker than you would have if you didn't get assigned. Hi, Tony. Would you be doing any webinars on index-based options? So I'm actually talking to NASDAQ right now about doing some of that, but that's still in the works, and it's not something that we are looking at. We are talking about, with TMX, doing some events on SOX, which is the S&P index options. There's also the Canadian USD index currency index options. Those are some of the things that we're going to discuss. So we may be doing those very soon, Jan. Is there an option position if an options position is not going our way, can we do something to cut losses to make it profitable back? I would say that if there was, everyone would be doing it, right? So there's really no way for you to turn it back without necessarily either changing the risk profile. You usually have to increase the risk or in some ways change the risk profile of the trade. There isn't some magical way that just somehow reverses the losses of the trade, or else everyone would do it. But here's one of the things that I want to, I want to point you back to the webinar that I did 2 weeks ago, which is risk management and money management. And this concept of constantly wanting to win. if you feel that you're constantly in the position where you don't want to lose, I highly recommend you to watch the video from 2 weeks ago where we discussed the trading psychology and learning that losses are part of trading. And as soon as you can learn that and accept that, the better you will be, because the more you keep trying to convert losers to winners, the more risk you're likely taking in the event in doing so, which is where you predominantly will get yourself into more and more trouble. I've seen this over and over again as 13 years as a strategist working with traders, where traders constantly try to win at every single trade. And what they do is they do it at all costs. And guess what? All costs many times means blowing up your account, just trying to keep your losers from, keep your winners from turning into losers. And I've seen so many traders that, have a losing trade but won't let go to it, add onto that position, get themselves into a bigger loss, add on more. Before you know it, they've blown up their accounts. I've seen it over and over and over again. The sooner you can just let go of a loser and move on to the next trade and not let that bother you and continue to consume you and cause you to do things that you wouldn't have done in the first place, that's when you become a more successful trader. So I highly recommend you to watch that video from a couple of weeks ago. What would help is to go do some option chains of different stocks and explain the decision-making process. Okay, great. That's great feedback. That is what we're going to do next in a couple of weeks. That's exactly the point of why we do these live market analysis. We're going to take what we've learned, we're going to take it to some real strategies and show you. So that's why we do these now in these courses, right? Instead of just doing a segment each week, we talk about risk management, we talk about optimal expirations, and next week, we're gonna show you how to apply them to real examples. So with that, I really appreciate everyone taking so much time here to participate in answering and asking questions. Unfortunately, there are so many questions here. I cannot possibly get to all of them here today, but I really, really recommend for those of you that are new to take the time to watch the recording. We will send the slides out to you afterwards so that you can follow this at your own pace. And I really encourage you to continue coming to these webinars, especially next week, where 2 weeks from today, where we're going to just focus on answering your questions. So please come prepared with more questions. We're going to go through some real examples and show you how to apply what we've just taught you to more symbols in more, I would say, a more practical approach to doing this. And then you guys can submit symbols and submit your questions, and we'll spend time answering that. So with that, thank you so much. I hope you guys have a great afternoon, and I will see you guys here in a couple of weeks. Have a great evening.